Hello, everyone, and welcome to The Buck Stops Here. I'm Catherine Murray. Well, as we've been discussing, and I've been pointing out since the back half of 2022, and really throughout all of 2022, it's been a very difficult market, and I think that 2023 seems to be setting ourselves up for the same. There's a real tug of war between the bulls and the bears. There's still a lot of unknowns, specifically surrounding inflation and or what the Fed may or may not do. So I want to continue to give you great perspectives from some Wall Street veterans. And today, Thomas George is joining us. He's the founder of Grizzle and the portfolio manager at the ETF GRZZ. And he joins us now. Thomas, great to be with you. And I also want everybody to understand as well your background. You were at TD running the commodities department and also on the Canadian equities team as well for running money. So a lot of background to be able to share with us. And I want you to maybe just give a bit of a detail in terms of what you try to do with this Grizzle ETF, which was a huge outperformer versus the market last year.
Yeah, so obviously a tough year last year, but we're a growth ETF, and it as you know, Catherine, growth stocks had a tough go. We outperformed the Nasdaq by 13% last year, and we categorize ourselves as disruption at a reasonable price, growth at a reasonable price. And if you think of what's the exact opposite of that spectrum is ARK, and we outperformed ARK by 47%. She was down 66%. These are volatile markets, and no markets get hit more than growth equities. Like that's like where everyone's shoot first, ask questions later. And same goes with commodities. So we get a rush out of those kind of markets, but clearly it's not for the faint at heart. But truly, we believe that that's where you really get the upside as a long-term investor.
Yeah, I appreciate you saying all of that, and it gives us kind of context and perspective in terms of understanding where you're coming from. Talk to us a little bit right now about how you view 2023, and I say that in the sense that we can all have these kind of big picture conversations, but I also think that what's been critical in 2022 and will continue to be so is you need to be an active investor. I mean, you don't need to be trading it yourself, but you need to have somebody in the market who knows markets and understands the importance of really picking the right sectors, the right stocks for you if you don't do it on your own.
100%. I couldn't agree more that it being active right now, being quick to understand things are moving so quickly, and the dynamic nature of where we sit, and especially with respect to interest rates, we sit on every last word from the Fed. That is really what's going to drive so much of what's happening today. But I think genuinely where we're sitting right now, that this sell-off, broad market sell-off, has presented extreme opportunities that we think are exciting to capitalize on. There's dislocation. Dislocation is when you make money, right? When everyone's singing from the same hymn book, everything's pretty much priced in at that point. That's when you look at the COVID recovery. We're all going to be on Zoom. We're all going to be doing these things. It'll be forever time. Amazon will be delivering boxes to my house forever. And lo and behold, and you just take that for that's a fact. And that's not the case. What gets me really excited, coming back to your point about being active, is the fact that no one really knows. There's a lot of discrepancy in the market, and that to me is always a great indicator source for alpha.
Right. So the opportunity alpha to make high returns. But by doing your homework, you got what I love about now is it brings me back to actually when I started in the business in 1995. At 97 is when I got into the equity research at William Blair. I mean, you do the fundamental analysis, you do your homework, you'll pick the right stock and you will outperform. There's just no doubt about it. I want to get your take though, and we're going to have a couple conversations here in terms of where you see these opportunities and this dislocation to take advantage of. But let me just start with technology. What are you seeing there? Because so many people have been so hurt by watching those stocks drop.
Yeah, if we rewind back to the start of 2022 and said, this is the carnage that we'd see in the largest, most household names in technology, stuff that we use every day, that valuations were that extreme. If you told me that this is where we'd sit, I'm like, no way. But here's where we sit, and that therein lies the opportunity. There's some really interesting news out of Microsoft, but we think big tech is one of the most undervalued opportunities, and is one of the places to be for 2023.
Okay. which is counter to what a lot of people are feeling and seeing in the market. But we are seeing some of those stocks stabilize. Thomas, we're going to take a quick break. When we come back, we'll dig into a few more details in terms of the various mega cap tech stocks that might be in your portfolio that you've seen some significant underperformance in as of late. But we'll be right back. Thomas, I want to dig in a little bit more in terms of why you're bullish on tech, because I think a lot of people would like to be, but they're almost shell shocked because, as you say, there's just been so much carnage within the space. So what are some areas, or what do you look at that gives you confidence to go into tech?
Yeah, one interesting data point that came out that was Morningstar has, they aggregate fund flow going all the way back to like early 90s, 92, like when the data first started to really start to get compiled. What's interesting here, we've seen the largest tech outflow out of tech funds and ETFs ever in the history of them compiling data. If you think about that, that's kind of curious. Like the largest outflow ever. What would happen in the dot-com bubble? Wasn't surely not, valuations we were trading on 76 times earnings going into that, right? We were trading on 30 times going into this. Like you would surely think the outflow would be far more dramatic in the dot-com. In fact, it was a trickle. It was a trickle of money out over the next several years. So the swing of the pendulum out of this has been incredible. And I think that's coming back to volatility presents opportunities. Again, now you're looking at large cap names that have, there's no liquidity risk here. Like, this is Google's, this is you're talking about Meta. You're talking about companies that are on the forefront of innovation that are trading at the lowest multiples in their history, right? And that to us is very interesting. So a Google trading on 15 times earnings, a Meta trading on 12 times earnings. Like, this is not price to sales, price to magic type. You don't have to like price to eyeballs, whatever it was back in the dot-com bubble, right?
That was it.
You don't have to. That was it. You don't have to stand on your head to make this all work. Obviously, these are dynamic markets, but I think we'll talk about it a little later. But the Microsoft news shows you incredibly, and Chat GPT is that you need to have a position in tech, right? You don't want to be a Luddite. You don't want to be the caveman in investing. I get it. A lot of resource investors kind of steer that way. Like, I hate tech. I hate everything about this. How can you say that? Like let me record your entire life from start to end, from the moment you wake up. And I guarantee you how much of your life is interacting with tech, right? And that I always find interesting about commodity investors. They're always like, I don't need that. Just give me a barrel of oil to sleep on. And you know what I mean? I'll be fine. And I'm not saying you don't have oil and natural gas in your portfolio, but you
can
live with the reality of your everyday life.
Absolutely. Including oil. Absolutely. But,
Yes.
but Thomas, I want to get your take. What's the Microsoft story to you? What is it?
Yes, the Microsoft story is incredible, right? So let me just rewind with Satya Nadella, right? The CEO. So literally, if you want a case study, and I'm sure there'll be incredible case studies written about this, but do you remember the Steve Ballmer era? Like, Steve Ballmer was the previous CEO of Microsoft. Basically, took that company nowhere, right? It was the definition of dead money up till 2014. And let me put this backdrop. This is like in the backdrop of a raging bull market, right? Like equities are all going up, tech stocks are going up. Microsoft was a dead company. Satya came in and literally retransformed the company. Like everything was like basically took the software business, what we know is Office 365, put it on the cloud, basically sent that to the moon. Then LinkedIn, which is still not the greatest social media platform, but made it one of the most profitable that there is. Xbox, the hits keep it's just such an incredible, when you have an incredible operator, and then when coming to this Chat GPT, which is AI. And what we think here, and this is very interesting, is that this is cutting edge technology. They took a bet on this in 2019, $1 billion. And now they're saying, listen, I'm going to throw $10 billion on this and really, take a 49% stake. They're going to get 75% of profit until they get their $10 billion back. It's an incredible deal. I think where we're going to see Chat GPT, which is basically you type in a question, you get a real clean answer. How how that's going to transform a lot of industries. A lot of people are just saying, oh, well, it's going to be about how you type stuff. And, what I mean? Like, I type a paragraph better than that. Sure, you do. But talk to developers. If a developer can double their productivity, that to me tells me I don't need to know about the paragraph written right or whether it's politically correct. Could care less. I care about the most important engineers in the world right now are programmers. Can I double their productivity? Oh, heck yeah, I can with ChatGPT. And that to me is one of the most profound examples of AI.
So we only have about 18 seconds in this segment, but I'm wondering how all over are portfolio managers in the Microsoft story, do you think?
I don't think very well.
There?
I don't think very well at all. I think nothing's being priced. It was basically flat on the day. I'm like, listen, that's great for me because I want that. I want that asymmetry on my side.
So just with Microsoft, your view, like not a lot of people are really recognizing this next iteration for Microsoft?
No, I think I don't think you're getting AI priced in fully. And I think the type of bet he's made is again, very asymmetrical for him. I'll take the money back. Thank you much. Get my 10 billion back. Like, I think you get incredible optionality with this bet. I know there's a lot of controversy whether this really is a revolution. I believe it's one singular pillar that explains it all. Talk to a developer. Do they get powered up? And if they get powered up, that's super important to me because they're the most important engineers on the planet. It's like giving them steroids, Catherine. If someone said to me, this engineer is going to look like, Arnie, like, a month from now. Yes, give me that.
Yes. Yeah, we'll take it. I know. Especially after COVID. It's like, I feel like, we all need to be at the gym all the time and just getting the bodies back.
Exactly.
But, yeah, it's true. It's true. Thomas, I mentioned at the top of the show that, you were head of resources at TD for many years. And I want to get your take in terms of what looks interesting today.
Yeah, so it's a super interesting space. We're very bullish on battery metals specifically, right? And so, and we also like natural gas, and we think that there's a countercyclical, there's a trade there in a value trade. But let me talk about battery metals. I think that's inventories in the major battery metals are sitting at their 5-year lows, right? Like they're bombed out in terms of inventories. Like we just don't have enough nickel, copper, right? And lithium, again, the types of deals that are getting done in lithium, like Tesla had to renegotiate with one of their suppliers to say it was a fixed contract of pricing. They've renegotiated to spot. So we think, again, big picture, own battery metals. I'd say lithium, nickel, copper. These are the key ones to own. On the lithium side, SQM, that's a large cap play. It's traded in the US. On the nickel side, I think it's a very interesting space. We like Canada Nickel there. I think that they've got a great asset. And then on the copper side, an interesting play there. We own Hudbay, but we also own a stock Amerigo, and that has an 8% dividend yield. So you get this kicker there. And then also a minor metal that's very interesting is vanadium, Largo. Largo Resources is the largest player there. And vanadium, there's a vanadium redox flow batteries that are really starting to take off. So I think there's a whole bunch of interesting plays you can play across the battery metal spectrum. And I think, and then a defensive play, I got to give a defensive play is Nextera. Nextera is it's a large cap U.S. utility based in Florida. Two great things about it. If you ever tell me there's a regulated utility in a Republican state, I like. If you tell me that they're building a lot of renewables, I like. You rarely do get both. Rarely do. And in Florida, you get both. So they're building out a ton of renewables. It all goes into their rate base. They get a great return on it. So I've got great visibility out to 2015 to get 10% CAGR of EPS growth that's highly visible. Again, that's my defensive play. But I think there's going to be we're really interested in the yield plays that are out there today. We're one of the unique ETFs that our dividend yield is 1.75%, which is actually kind of nice. You get full growth. We own literally. We're torqued to growth. We don't have any consumer staples, or we're not defensive in any way. But we're like, listen, just if I can get paid along the way, I love that.
Yeah, no, that's great. Just even looking at the XLF, I was looking at this yesterday, and I think it's it's a 2% dividend yield, so 1.7 with, to your point, the growth torque that you're trying to find within the ETF, the Grizzle ETF, is interesting. But I want to ask you though, the company that you said has an 8% dividend yield. That is, what's the ticker there?
Amerigo Resources.
Okay, and the ticker?
Amerigo, ARG, ARG.
ARG.
Yeah, yeah,
We
super
have to.
interesting. So that's actually an interesting play. That's actually because they actually they're not even a miner. They're a wastewater treatment plant. So they basically are downstream from the largest copper mine in the world, Codelco's mine in Chile, and they basically treat the effluent and get copper. And so like you've got a fixed cost setup. They don't have a high maintenance capex. It's a very interesting play.
But we only have 26 seconds, but what's the issue? There's got to be an issue there if they're giving it an 8% yield. What's happening there?
No, so the idea is it basically you get a security that gets full torque to the upside for copper, and the dividend is covered with free cash flow. So it's a safety play, but with torque to the upside, right? You're not getting the production growth, right? That's fair, right? So it's just whatever effluent comes
Okay.
through, they treat it. But if I just want inflation protection, which most people do, then I get that. And I also say, well, listen, copper 5 years from now is going to be double. Okay, I'll get the kicker. They'll do special dividends and buybacks. Plus, I get the 8% coupon.
All right, we'll take a quick break. We'll be right back. Thomas, I just want to kind of recap a little bit with Amerigo, ARG, the ticker there. You're expecting the company will have share repurchases, just kind of a bit of a steady eddy on the cash flow front. You like
Yeah,
it?
so it's a unique business model for a lot of reasons, but one of them is just return of capital. Like, at the end of the day, what is a business that you buy? Like I think a lot of people forget, like, you get into stocks, like I got a conceptual view, this is what, like, when you have a business that pays out a big dividend, that's actually the fundamentals of a business, right? It's like, okay, well, obviously, you're looking at, well, what do I get? Well, if the copper price goes up, I get share repurchases plus special dividends. I enjoy in that kicker up, but I also know that their base dividend is covered at low copper prices, and that to me gives me certainty that there's free cash flow cover, and then I get the kicker up. And to me, also, we like gold a lot in 2023. I forgot to mention that we like gold a
Oh,
lot,
yeah.
and I can talk about that in a bit. But to me, my inflation protection basket is a bunch of things. It's a bunch of things, right? It's copper. It's battery metals. Right now, what's really interesting is nickel is one of the best performing commodities. Full stop. One of the best performing commodities, but the stocks are so banged out. So we looked at it like last year, nickel say up 30%. The entire sector is down 50. Like all the juniors are down 50.
This,
I like that. I like that.
mm-hmm.
You did not see that actually in lithium last year. Lithium did incredibly well. Stocks did very well. So our SQM was up 71%. It was one of the top performers in all of the electric vehicle the supply
Wow.
chain, right? So last year was a very interesting year. We made a clear bet that we're not going to own Tesla in any sort of meaningful way. We own a little bit, but we're not going to own downstream. We want to own the mine. We want to own the metals themselves. So from our perspective, this year could be a great year for the lithium stocks themselves, the mining stocks, and then secondarily, you copper. You just want to own these hard assets. But we like gold a lot. I forgot to mention that we like gold a lot.
Okay. George, Thomas, you told me a couple of years ago, I think, or at least a year ago, to buy SQM, and I didn't buy it. Can you buy it today?
I would tell you we still own it because I'm still bullish on lithium. But in the ETF, we actually had it at a 10% weighting. We don't mess around. If we like a stock, we'll just get it, put it big. So we like it. We put it at 10% weighting. It was easily our best performing attribution stock in the entire ETF. Now it's at 5%. Listen, still big, but
Okay.
not. I'm on my overall weighting, it's less excited. But I'll tell you this: nothing that I'm seeing right now tells me that we're going to hit a wall and of new lithium supply. It will come. Don't get me wrong, but there's a whole bunch of different reasons why production for all commodities are going to take time longer. It's just going to
Mm.
get harder. You have ESG. ESG is like, this is a big thing, right? Just it's going to take longer to get these mines permitted than supply. If on paper it says 3 years, the reality is probably 8.
Yeah. No,
You
great
know, and
point. Yeah, go ahead.
no, but they, and I'm making a point for lithium, but that's the same point for copper. That's the same point. You go across the spectrum, and again, we got fairly good visibility about the inventory levels. Incredible visibility on these inventory levels. They're all very low, and we got great visibility on which mines are coming on. Like, there's no surprise mine, right? So
Hmm.
you've got a pretty good idea, right? What we don't have control is the economy, right, Catherine? Like, that's the unknown part of this entire equation, which I will say, uh, prior to China lifting COVID zero, I think everyone would be like, listen, this, if recessions hit, this is going to be a tough year for any cyclical commodities. But now you have this other force now, which is China reopening. And, if you look at travel, everything coming out of China, incredibly bullish for commodities and just, consumers, the Chinese consumer, right, and all that comes with it.
Yeah, absolutely. I think read yesterday that the flights out of China are up 254%. I mean, not surprising there. We only have about 10 seconds left, Thomas, but I guess bottom line, though, in terms of going bullish, the battery metals, you are bullish on EV. You say you're not going to be necessarily buying the cars themselves, but obviously this is the push that you believe we'll see. You got 5 seconds.
I think the ubiquity of I'm still bullish on oil. We can't deny the fact that EVs are going to continue to penetrate, even if it's a modest growth.
Okay.
We just don't have enough metals
Okay.
for it. Simple as that.
Got it. Tom, it's great to be with you. Thank you once again, always, for your insights and incredible knowledge. Appreciate it. Thank you so much. And thank you, everybody, for watching.